Indicators are an essential tool for traders like you, and I'm going to show you 3 of the best for trading gold. Now, covering a chart with lines might look scary to beginners, but they're an essential tool to understand and master. Indicators are statistical methods used to forecast potential future movements of an asset price based on historical price patterns and volumes. The right indicators can help you make more informed decisions, potentially leading to more successful trades. Now, I remember back in my graduate days on the desk, I sat down with one of the experienced traders and he tried to teach me technical analysis. To me, it just looked like a bunch of lines on a chart. What on earth could I make out from this mess? But then gradually I realized that this was how you got a true insight into the psychology of market participants. Even if you just believe in the fundamentals, using chart analysis can help find your buying point. It can help set your stop losses, because this is the psychology of the market right there on a chart in front of you. The relative strength indicator, or RSI, is a momentum oscillator that measures the speed and change of price movements. It oscillates between 30 and 70 and can help identify when gold is overbought or oversold. Think of it like a traffic light. If the RSI is below 30, it's like a green light indicating go, suggesting gold is oversold. Conversely, an RSI above 70 is like a red light indicating stop, but in this case it means gold might be overbought. Let's take a look at this chart. Under indicators, search for RSI. Find the relative strength index, which we add to the graph. Now, the RSI is added at the bottom of the screen, and as you can see, moves between 70 and 30. In this particular example, March 2020, as the gold price dropped to 1480, the RSI hit a low of 30. If we had bought at this level and we had held gold all the way up until the RSI was approaching the upper band at 70, we would have made profit of nearly $200. As an indicator, moving averages are beautifully simple yet effective. They smooth out price data to create a single flowing line, which makes it easier to identify the direction of the trend. There are several types of moving averages, each with its own strengths. The simple moving average calculates the average price over a specific time period. One of the primary uses of moving averages in gold trading is to identify the direction of the trend. Now let's look at this chart of 2 moving averages to show when it can be useful to pick out trading opportunities. This line is the average price over the last 50 days, or the 50-day simple moving average. The purple line is the 200-day moving average, or the average price over the last 200 days. Now, traders often watch for crossovers between short-term and long-term moving averages as signals of potential trend reversals. So here, when the 50-day goes up through the 200-day, that is known as a golden cross and can indicate the right time to buy. However, it's crucial to remember that in a sideways or consolidating market, moving averages may lead to false signals. Another important aspect of moving averages is their role as dynamic support and resistance levels. In a bullish trend, the moving average can act as a support level, a floor that the price seems to bounce off. Conversely, in a bearish trend, as we can see here in the chart, it can act as a resistance level, a ceiling that the price has struggled to break through. Bollinger Bands measure market volatility. Let's take a look here on the chart. Bollinger Bands consist of 3 lines, the middle one being a simple moving average. The upper and lower bands are standard deviations away from this middle line. So, when the bands widen, it indicates an increase in market volatility, suggesting that traders should expect larger price movements and potentially more trading opportunities. Conversely, when the bands contract, it signifies a decrease in volatility, indicating that the market is in a more stable phase. Now, Bollinger Bands can be used in various trading strategies. One popular approach is the Bollinger Bounce, and this would have told you to buy gold here as it touched the bottom band. We would have paid a price of 1,820 for gold, and we would have held the position all the way up through this phase until the price hits the upper band, or selling at a great profit, 1,960. Indicators are invaluable tools, but they are not infallible. They require practice, understanding, and a cautious approach. As a gold trader, using these indicators effectively can significantly enhance your trading strategy, leading to more informed and potentially more profitable decisions. Check out our video on the best gold trading strategies, and be sure to subscribe to our Trading Takeout series on YouTube for a daily dose of market insight and wisdom.